Welcome, viewers, to Body Unified Flow. Here we simplify complexity and amplify performance. Today's explainer is titled Money Basics and the Financial Safety Net, Part 9, Avoiding Insurance Traps. You know, if you've ever felt completely overwhelmed by the fine print of financial protection, or if you've ever just sat back and wondered, is this policy I'm paying for actually going to protect my family when disaster strikes? Well, you are in exactly the right place. We're going to completely demystify how to build a bulletproof financial safety net. To get us there, we're going to walk through a really precise diagnostic breakdown of where people typically go wrong. We'll start with a welcome to the safety net, explore the dangerous bundling trap, navigate those tricky proposal form pitfalls, debunk the employer insurance illusion, look at how to build true resilience, and finally wrap it all up with a summary and our references.
All right, Section 1, Welcome to the Safety Net. Let's begin our structured journey into real, reliable financial protection.
By the end of this explainer, you are going to walk away completely empowered. You'll be able to instantly identify dangerous insurance traps that literally drain your capital. You'll learn how to completely decouple your insurance from your investments, easily navigate those tricky proposal form pitfalls that catch so many people off guard, and ultimately build an independent safety net that actually works when life throws a severe curveball at you.
Okay, let's dive into this. A financial safety net isn't just a basic savings account sitting in your local bank, right? It is a fully integrated framework. I want you to think of your investments, your equity, and your compounding growth as the high-performance engine of your wealth. Now, this safety net, with its specific risk transfer mechanisms, like insurance, well, that's the essential armor protecting that engine from catastrophic disruption. Because without this armor, a single medical crisis or unforeseen tragedy can force you to liquidate your hard-earned assets, and that can completely derail decades of compounding. We definitely don't want that.
Moving on to Section 2, the dangerous bundling trap. Here we confront the core villain of our explainer.
The absolute biggest mistake you can make is treating insurance as an investment. Honestly, they are literally like oil and water. Insurance is pure risk transfer. It's an expense you should gladly pay to protect your wealth from the unknown. Investment, on the exact opposite side of the spectrum, is all about wealth creation and compounding growth over a long horizon. When you try to mix them, you dilute the effectiveness of both. You absolutely must treat your insurance premiums as a strict expense and nothing more.
But notice how the industry packages this trap. Products like ULIPs, unit-linked insurance plans, and endowment plans are aggressively marketed to consumers as this great, forced savings vehicle, supposedly with the wonderful added peace of mind of life cover. But guys, it is an incredibly expensive illusion. Bundling these functions results in you paying way more for significantly less. You end up with severely inadequate life coverage that wouldn't actually replace your income, and simultaneously you get terrible, highly inefficient investment returns because of layers of hidden administrative and mortality fees. Inflation essentially eats these returns alive.
You have to be incredibly vigilant, especially at your own bank. In fact, the Reserve Bank of India has cracked down heavily on bank-led sales, known as bank assurance, due to dark patterns like compulsory bundling. This is where a home or auto loan is made secretly contingent on you buying a specific expensive life policy. Watch out for the aggressive push toward unsuitable high-premium products, and please be highly skeptical of the tax-free illusion. Often, relationship managers will pitch the immediate tax benefits of a ULIP under Section 80C while completely hiding the massive early-year allocation charges and the strict 5-year lock-ins that trap your liquidity.
Let's jump to Section 3, Proposal Form Pitfalls. This is where we tackle the exact moment a perfectly good safety net can be destroyed before you even need it.
We buy insurance for the immense risk of the unknown, right? That grim reaper always lurking in the rearview mirror of life. But here is the terrifying reality we have to face. When tragedy actually strikes, the insurance company isn't just going to blindly hand over a check to your family. No way. They are going to ruthlessly and forensically scrutinize your original application form, which leads us to a really critical warning. So the crucial point is this. The number one reason claims are denied and completely rejected in India is the non-disclosure of material facts. Lying, or even slightly bending the truth on a proposal form just to lower your annual premiums by a few thousand rupees is a terrible, wealth-destroying idea. Insurance companies have incredibly sophisticated investigative teams. They will almost always uncover pre-existing conditions during a claim investigation, leaving your family with absolutely nothing but a rejected claim letter.
There are strict danger zones you must declare personally, without relying on an agent to just fill the form out for you. Medical history means everything. Every past surgery, every chronic condition like thyroid or diabetes. If you take a pill for it, declare it. Lifestyle habits are huge too. Hiding a social smoking habit or weekend drinking is a massive red flag. Nicotine traces can be found in your medical records or body years later. And if your death is even remotely respiratory related, your family's claim will be entirely repudiated. Also, always declare your existing policies to avoid human life value or HLV fraud. That happens when you try to buy way more total cover than your current economic value or income actually justifies.
All right, Section 4, the employer insurance illusion. We really need to address a very dangerous assumption made by millions of salary professionals.
I want to ask you directly, is your employer's health insurance actually enough to protect you and your family from a catastrophic medical bill? It is so tempting to say yes, right? Just say yes and save that premium money every year. But the answer, unfortunately, is a resounding and absolute no. Here is the terrifying reality of relying solely on corporate coverage. The exact moment you resign to take a break, switch jobs, or face a sudden layoff, which, by the way, is precisely when your primary income is completely vulnerable, your employer insurance disappears instantly. Poof, gone. You are left entirely exposed. Independent health insurance, however, stays with you permanently, bridging that incredibly dangerous gap and ensuring you never lose the benefit of continuous coverage.
And you need that permanent, robust coverage because of this staggering number. 15%. Medical inflation in India is running at roughly 14 to 15% every single year. Because of this aggressive compounding cost, a serious illness, an ICU stay, or an advanced surgery today can easily wipe out 15 to 20 lakhs of your personal savings in a matter of days. A standard procedure that cost 5 lakhs a few years ago might cost double that today. Your employee's basic 3 or 5 lakh group cover simply won't cut it anymore against these modern healthcare costs.
So Section 5, building true resilience. Now that we've diagnosed the traps, let's shift gears and focus on the actionable solutions.
And this brilliantly illustrates the ultimate goal, to be the person holding the shield. Proper risk transfer mechanisms act as a strong perimeter defense against the catastrophic tail risks of life. You want all the heavy financial risk of medical emergencies and premature loss of life formally transferred to a large financial institution. Why? So your personal net worth, your equity portfolio, and your family's future remain perfectly intact and safe.
Let's look at how this builds into a definitive checklist. Here is exactly what you do. Buy pure term life insurance. Avoid ULIPs and endowments entirely. Buy a comprehensive, independent health policy of at least 20 to 25 lakhs. Do not rely solely on your employer's limited cover. Ensure absolute full medical disclosure when filling out your forms. Never hide lifestyle facts just to save a few bucks. And finally, buy your term life cover only until age 60, not until age 99.
Let's unpack a few crucial pro tips on that term insurance, because this is important. First, ensure you are reasonably fit before taking your required medical tests. Poor results can permanently spike your premiums or even cause an outright rejection. Second, always add a critical illness rider. This is absolutely vital because it pays out a tax-free lump sum if you are diagnosed with a major disease like cancer, helping replace your lost income during the 6 to 12 months of intense recovery. And finally, avoid the heavy marketing trap of buying cover until age 99. Think about it. Once you retire around 60, you have no future income to replace, and ideally, your investments have compounded enough that you have no dependents relying financially on your daily paycheck. Paying extra premiums for life cover until 99 makes zero mathematical sense. It is literally a total waste of your capital.
Section 6, Summary and References. We have covered a lot of important ground today, so let's quickly summarize our journey. To recap, you now firmly know that insurance is strictly an expense, not an investment. You know to always, without exception, decouple your pure term and health covers from wealth-building products like ULIPs. You understand the critical, non-negotiable importance of disclosing all medical and lifestyle facts honestly to ensure your claims are actually honored when it matters most. And you know exactly why securing an independent 20 to 25 lakh health policy is the absolute baseline for true resilience against modern medical inflation.
I want to reiterate this final thought that should permanently change how you view your financial safety net. Say it with me again. Insurance is an expense to protect your wealth, not a tool to build it. Once you truly internalize that single concept, you become virtually immune to 90% of the financial mis-selling happening in the market today.
Here are the references and source materials we utilize to build this explainer, including excellent insights from the Zero-Da Varsity series, World Bank documentation, and RBI directives. I invite practitioners and learners of all levels to explore these specific resources further to really deepen your understanding. Thank you for joining us at Bodhi Unified Flow. Before you go, ask yourself this. If a medical or financial emergency struck tomorrow, is your safety net a bulletproof shield or just an expensive illusion? Keep simplifying complexity, and we'll see you next time.